The Property Bulletin by London Property, the home of superprime.
In a positive development for the UK property market, a number of lenders have recently announced reductions in mortgage rates, despite the Bank of England holding the base rate steady at 4.25%. While this may seem surprising, experts say it reflects growing confidence among lenders and a broader shift in market sentiment. According to Caroline Marshall-Roberts, CEO of Buy Association, the cuts suggest lenders are beginning to anticipate a more stable economic climate. Even though the base rate hasn't changed, the market is clearly positioning itself for potential easing. There's a sense of predictability returning, which gives investors more clarity and confidence in planning ahead. So, what should property investors do now? With this shift, investors may be wondering whether it's time to act. If you're on a variable rate mortgage, now is a good time to review your options. Fixing your rate at today's lower levels can shield you from future rate increases and help stabilize cash flow over the medium term. The current base rate pause is promising, but it doesn't mean rate cuts are guaranteed. It's important to pay attention to inflation trends, Bank of England signals, and economic forecasts. These will guide next best moves. It's good to focus on improving returns from existing properties. Simple upgrades, energy efficiency improvements, or better tenant amenities can boost rental income and reduce voids. Rising costs have made cash flow protection more important than ever. Think of looking for properties in more affordable areas or deals with lower borrowing requirements. Smaller investments can offer strong yields without overexposing your capital. In uncertain times, tenant retention is vital. Aligning rents with the market conditions can help prevent costly voids. A well-priced property attracts quality tenants and ensures steady income. The fact that lenders are willing to cut rates even before the Bank of England moves suggests they're betting on greater long-term stability. For property investors, this offers a moment to regroup, reassess, and act strategically, not impulsively. Signs of confidence and opportunity are returning, especially for those who are prepared and informed. Barrett Redrow, one of the UK's largest house builders, has reported a sharp drop in home sales, particularly in London, citing high mortgage rates, fragile buyer confidence, and reduced international interest. The company sold 16,565 homes in the year to June 29th, falling short of its forecast of up to 17,200, with London singled out as the most challenging market following the end of stamp duty discounts and continued affordability pressures. Shares fell as much as 13%, wiping £778 million off its value. The company also revealed an additional £98 million in cladding repair costs, bringing the total to £248 million, after identifying issues in its southern divisions and a large London development. Despite these setbacks, Barrett Redrow expects to sell between 17,200 and 17,800 homes in 2026, and remains committed to its medium-term goal of delivering 22,000 homes annually. CEO David Thomas acknowledged the market challenges, but pointed to an improving mortgage environment and the UK's ongoing housing shortage. The update comes amid wider market concerns, as new build sales in London hit their lowest levels since the 2008 financial crisis, and rival builder Vistry also reported a one-third drop in profits due to weaker affordable housing demand and funding uncertainty. New data from the ONS reveals that UK average house prices rose 3.9% year-on-year to £269,000 in May, showing resilience in the housing market despite economic uncertainties. Industry experts point to competitive mortgage rates, rising demand, and policy changes like the Leeds reforms as key drivers. First-time buyers now make up 64% of mortgage searches, highlighting renewed interest, but affordability remains a challenge, especially after the April stamp duty changes, which increase costs for many. Some experts argue for more flexible tax options and broader support to keep homeownership within reach. The return of 100% loan-to-value mortgages and relaxed affordability criteria are helping to boost accessibility, but come with increased risk. Despite this, sales activity is strong, with May being the busiest month since 2022, and buyer confidence is climbing, particularly in the prime market, where recent price drops have sparked renewed interest. While lenders have been cutting rates, a surprise inflation rise may delay further Bank of England base rate cuts, adding uncertainty. Still, the two-year fixed-rate average has dropped to 4.53%, down from over 5% last year, and many expect rates to fall further if inflation stabilizes. Overall, the market remains price-sensitive but active, with experts calling for longer-term solutions, especially increased housing supply, to sustain growth and keep affordability in check. The direction of the market in the second half of 2025 will likely hinge on interest rate decisions and broader economic signals. Average monthly rent in London has soared to £2,252, the highest in the UK, according to the latest ONS data. Nationally, average UK private rent rose by 6.7% year-on-year to £1,344, a slight slowdown from the 7% growth in May and well below last year's 9.2% peak. The most expensive local authority was Kensington and Chelsea, £3,616 per month, while the most affordable was Dumfries and Galloway, £521 per month. Regionally, the North East saw the fastest rent growth in England at 9.7%, while Yorkshire and Humber had the slowest at 3.5%. In Wales, rents rose 8.2% to £804, and in Scotland, more modest growth of 4.4% pushed average rents to £999. In Northern Ireland, rents hit £852 in April, up 7.6% annually. Rental prices are rising alongside house prices, which increased by 3.9% to £269,000 across the UK, driven by market stability and increased listings, now at a 7-year high. In London, the lettings market remains robust. According to Foxtons, applicant numbers jumped 21% month-on-month in June, and new listings hit nearly 45,000, the strongest supply in 4 years. Average weekly rents rose to £593, up 1% from May. Experts say the increased supply is easing pressure on renters, while landlords benefit from strong demand and pricing stability heading into summer. Despite affordability concerns, the market is showing signs of balance returning between supply and demand.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.